Hi, welcome to the Market Alert, Friday the 5th of February 2016. And just before we start, I had a couple of questions yesterday with regards to trading in the pre-market session, as there's a lot of volatility in the first part. So is there a way of taking advantage in the pre-market? And the answer to that is yes. So the first question is, how do we know that the market's going to move sufficiently to generate profits? And the second question, or the other thing to keep in mind, of course, is that the spread is 3 points from ETX in the pre-market session and the post-market session, but during the session it drops down to 1. So the first question is, how can we tell if it's going to be possible to trade in the pre-market session, and the times, of course? Well, this is the end of the official session there. That was Wednesday's session when the Dudley issue, when he spoke, and the market moved higher. And then after, you see the market moving over 100 points, and that's the clue. If the volatility is around in the overnight market, then you'll see at least 100 point move, or close to 100 points, to give you the trades. Also, you only get on the overnight market the kick in from the Asian markets. When they start, it adds to the momentum, which is what you're seeing here, and then the market will go quiet, which you'll see the market's now sideways, and then eventually you starts to come back. A few more signals, and now we're down at 7 o'clock in the morning. So you can see sideways after you've got the initial Far Eastern bit, and then the market coming back ready for the European markets at 7 p.m. when the DAX kicks in. So the DAX has kicked in, European markets are active. Draghi spoke yesterday. Super Mario, he was out yesterday morning. You can see the market started to move higher. Then they thought, you know what, he doesn't really believe in what he's saying. So the market came back, and his favourite comments at the moment of, we have the tools, and I'm sure Super Mario does have the tools that will help the citizens to become financial slaves for many decades to come by printing more money. They're already printing 60 billion a month and have been doing since March of last year, and they've also gone negative on rates as well, only on deposits at the moment. So all the market's cheered up by this. The bankers love it. The market comes back, and then the market will go quiet again around 10:30 p.m. till around midday. Yesterday, Barmy Carney was out, and you can see even the market doesn't believe him anymore. Unusually, he's the only central banker that can have this effect now. We see the market fall out of bed, and that's probably something to do with the fact that Carney's home of Canada is now 170% of debt to income. A cauliflower will cost you $8, a cucumber $4, and washing powder $36, as the Canadian dollar has crashed along with its economy. So that's the, no pun intended, the carnage that Carney left behind. And you can see that the UK investors don't believe a word that he says. And also, of course, yesterday he had to hold his hands up and say, actually, we have a problem, Houston. The growth forecast is less than what we thought. And also he's got to write another letter, naughty boy letter, to the Chancellor about why inflation isn't actually riding at 2%. But you couldn't make this stuff up. I mean, inflation cannot be held down, except when you give the bankers the QE money instead of it going into the economic system and lent out, or the banking system, and getting lent out as money to consumers. But of course that's what caused the problem in 2008, and they know that. So this time they thought they'd keep it for themselves and have huge bonuses, huge bubbles, and now we're seeing the unwinding of that as well. But I digress. So yesterday the market then opened, and we had this wild swings of around 70 points, 80 points for the first half an hour or more. Then the market broke out to the upside. This is very difficult to play, and you don't really want to play it because it's a whipsaw action. And I've said before, I'd rather have no trade than a losing trade. So we see the market with this whipsaw action, and eventually it runs out of steam, And again, the upside really is the direction they want the markets at the moment, but I'm sure this is going to change shortly. So we see the market come back, and even through the quiet time, we get a signal here. We see the market filling this signal and attempting to move higher and then running out of steam. Now, I think it was Tuesday's market alert where I showed you if the market hasn't moved higher within 4 bars and keeps coming back below the entry price, then, cut the losses. There's no point in exposing yourself to a 40-point loss on a trade. And I showed you that, I think it was Tuesday's market alert. And as prices come back, you can see there the market's attempting to make a higher low. It's struggling with the level here of 16,400, and then the market comes through. So you can actually reduce the actual loss, and the market's telling you it doesn't want to go up because each time it attempts to move higher, it's then bashed and battered to the downside. So the market comes down 50 points, and then in the evening session we get a sell signal here, and the market trades down at 19 points. In this bar here, it comes all the way down to 19 points. It then returns, bangs its head against the 16,350, and then comes back and gives you a second chance. And in this bar, I'll put an overlay on the screen now, the volatility in this bar was quite incredible. You could see that the plunge protection team had arrived, the cavalry had been sent out by the Fed, and the market then drove all the way back up. And then if you hadn't got out here to try and take some profits or cut your losses, the market actually came down more or less to break even once more. Because as I've said in the market alert for many weeks now, that the plunge protection team will do whatever they can to get this market to finish on a high, and in particular if the market has moved lower, as we see here in the earlier part of the evening session there. As there's one other thing just to cover as well, if there's no signals in the first part of the session, then you can go to the quieter session, and 1 or 2 people have said the signals are different in my chart than in theirs, and that's because I will have removed the hide indicators outside of primary trade times, and that will be the reason. So if you don't want to trade outside of the primary trade times, then you can just click apply, and that will remove the additional indicators there. But at the moment they are showing because of the type of volatility that we're having in the market at the moment. Very strange last couple of days, I have to say, but then Dudley was wheeled out on the one day. We had huge volatility in the first half, calmed down in the second, in the quieter time, which you'd expect, and then that remained for the latter part of the session as well. So in the daily chart, we've got an interesting sideways pattern going on. There's no real direction at the moment. The market's struggling with the 16,418 level on the overnight market. Today is a big day. We've got the non-farm payroll figures out at 1:30. This is a big one. So if you are trading in the pre-market session, you want to stay out. This will be wild. Because this is what Yellen has built her case for increasing interest rates, the strong labour market. The rest of the economy is going to hell in a handcart with the figures, but it doesn't matter. We have a strong labour market, and participation rate is absolute nonsense. It's a 1970s participation rate according to Gerald Celente, and I'd rather believe Gerald than Yellen. Frankly, because they have fudged the figures and removed 6 million out of the labour market during Obama's tenure at the White House. So keep that one in mind as well. And then finally, implied volatility 1862. That seems very low for yesterday. Let me just check that. 1862 it is, and the market just sideways there in the chart. A quick whiz around the globe. We've got the Shanghai down just 0.13. That was down a bit more earlier. You can see that in the chart there. The Baltic Dry Index, the shipping of goods, has made a new low. We're now below 300, the first time in history, down 1.65. And we've had a bit of a bounce in the commodities, purely and simply because crude oil has moved higher by $7 or $8 during the last couple of weeks, which is what supported the stock market as well. Even though we did have on Wednesday an 8 million surplus, this is ignored by the manipulators in this market at the moment. Right, that's it for today and also for this week. Have a great weekend. As ever, thank you for your support, very much appreciated. I will see you in Monday's edition of the Market Alert. Until then, thanks for watching. See you in the next one.